What if I told you that almost everything you think you know about taxes is completely wrong? You're about to discover 8 shocking tax myths that could be costing you thousands of dollars every single year. Some of these misconceptions are so widespread that even tax professionals believe them. And the truth behind myth number 6 will literally change how you file your taxes forever. Let's jump right into the biggest tax lie that's been fooling Americans for decades. Myth number 1. You can't negotiate with the IRS. This is absolutely false, and it's keeping people trapped in financial nightmares they could easily escape. The Internal Revenue Service actually has multiple programs specifically designed to help taxpayers resolve their debts. They offer installment agreements, offers in compromise, and even temporary delays for people facing genuine hardship. Here's what most people don't understand. The IRS would rather collect something than nothing at all. They're actually incentivized to work with you because a partial payment is better than spending years chasing someone who can't pay. I've seen people settle tax debts of $50,000 for less than $5,000 through proper negotiation. The key is knowing which programs exist and how to apply for them correctly. Moving on to myth number 2, and this one might surprise you. Many people believe that filing an extension automatically triggers an audit. This is completely untrue, and it's causing unnecessary stress for millions of taxpayers. Filing an extension is a normal part of the tax system that the IRS expects and accommodates. In fact, you're more likely to make mistakes when you rush your return, and mistakes are what actually increase your audit risk. Extensions give you additional time to gather documents, double-check calculations, and ensure accuracy. The IRS processes millions of extensions every year without any red flags. What matters is that you pay any estimated taxes owed by the original deadline, not when you actually file the paperwork. This myth is particularly harmful because it pressures people into filing incomplete or inaccurate returns. Myth number 3 revolves around charitable deductions, and this misconception is leaving money on the table for countless taxpayers. People believe you need to donate thousands of dollars before charitable contributions become worthwhile. This simply isn't true. Every dollar you donate to qualified charities can potentially reduce your taxable income, regardless of the amount. The real issue isn't the size of your donations, it's whether itemizing deductions makes sense compared to taking the standard deduction. With recent changes to tax law, the standard deduction has increased significantly, making itemizing less beneficial for some taxpayers. But for those who do itemize, even small charitable contributions add up over time. Plus, many people don't realize that volunteering expenses, like mileage to charity events, can also be deductible. Let's tackle myth number 4, which concerns business expenses for employees. There's a widespread belief that you can deduct work-related expenses even if your employer doesn't reimburse you. This used to be true, but tax law changes have eliminated most unreimbursed employee expense deductions for regular workers. The exception is if you're self-employed or work as an independent contractor. This change caught many people off guard because it was a significant shift from previous tax rules. Teachers, salespeople, and other professionals who regularly spent their own money for work purposes lost these deductions. Understanding current law prevents you from claiming invalid deductions that could trigger problems with the IRS. Now we reach myth number 5, and this one affects nearly every taxpayer. People believe that receiving a large tax refund means they're winning the tax game. In reality, a big refund means you've given the government an interest-free loan for an entire year. You've essentially let them hold your money without paying you anything for the privilege. The ideal situation is owing or receiving a small amount, indicating that your withholding or estimated payments closely match your actual tax liability. If you consistently receive large refunds, consider adjusting your withholding allowances to keep more money in your paycheck throughout the year. You can invest that money, pay down debt, or simply have better cash flow, instead of waiting for the government to return your own funds. Here comes myth number 6, the one I promised would change everything. Many taxpayers believe they must accept the first settlement offer from the IRS during disputes. This is absolutely false and potentially very expensive. The IRS makes initial offers based on their standard calculations, but these offers can often be negotiated or challenged with proper documentation. Tax professionals know that persistence and proper presentation of facts frequently lead to better outcomes. The IRS has multiple levels of review, appeals processes, and alternative resolution methods. People who accept the first offer often pay significantly more than necessary. Understanding your rights and the various options available can save thousands of dollars in many situations. Myth number 7 deals with record keeping, and this misconception creates unnecessary anxiety for taxpayers. People think they need to keep every single receipt and document forever. While good record keeping is important, the IRS has specific time limitations for most situations. Generally, you should keep records for 3 years after filing your return, or longer in certain circumstances like unreported income or fraudulent returns. The key is understanding which documents are truly important and which ones you can safely discard after the appropriate time period. This helps you stay organized without drowning in paperwork. Digital storage has also made record-keeping much easier and more reliable than traditional paper filing systems. Finally, myth number 8 concerns tax preparation software and professional help. Many people believe that expensive software or high-priced tax preparers automatically provide better results. The truth is that the quality of your tax preparation depends more on accuracy and knowledge than on cost. Some free software programs are just as capable as expensive alternatives for straightforward tax situations. However, complex situations involving business income, rental properties, or significant investments often benefit from professional expertise. The key is matching your needs to the appropriate level of service. Overpaying for simple returns wastes money, while trying to handle complex situations without proper knowledge can be costly. What makes these myths so persistent is that they contain just enough partial truth to seem credible. Tax law is complex and changes frequently, creating confusion even among well-intentioned people. Social media and casual conversations spread these misconceptions faster than accurate information can correct them. The real danger isn't just wasted money, though that's certainly significant. These myths can lead to missed opportunities, unnecessary stress, and poor financial decisions that compound over time. When you understand the truth behind these common misconceptions, you can make informed choices about your tax strategy and overall financial planning. Understanding these facts empowers you to take control of your tax situation instead of being controlled by fear and misinformation. Tax planning becomes less mysterious when you separate reality from fiction. You can focus on legitimate strategies and opportunities rather than worrying about problems that don't actually exist. Remember that tax situations vary significantly from person to person. While these myth-busting insights apply broadly, your specific circumstances might require personalized attention. The goal isn't to become a tax expert overnight, but rather to approach tax matters with accurate information and realistic expectations. These 8 myths represent just the tip of the iceberg when it comes to tax misconceptions. By questioning common assumptions and seeking reliable information, you'll make better decisions and potentially save significant money. Knowledge truly is power when it comes to navigating our complex tax system effectively and confidently.